My name is George Barrow. I am one of the fund managers on the Polo Capital Financials Trust. If we just move to slide 3, so just to give some brief background on the trust, it was launched in 2013 as a way to give investors global exposure to the financial sector. It has both an income and a growth mandate, current dividend yield of 2.8%. There is a 100% tender offer every 5 years at NAV less costs, with the next date being in 2025. Market cap on the trust is just over £500 million, and the discount currently is around 4%. So just give a brief overview of the kind of companies that we own in the trust. The banks is the largest subsector. It's just under 60% of the trust. And we have a quality bias to our holdings. We're looking for those companies that have strong balance sheets, good quality management, good underwriters of risk, and those that can generate sustainably high risk-adjusted returns. But financials is a very large and very diversified sector. So as you can see here, we invest across insurance sectors, both life and non-life insurance, but also diversified financials, which includes companies like asset managers, stock exchanges. We also invest in fintech, and that's becoming a growing part of what we do. So we look large to small cap and in developed markets and emerging markets. So turning to performance, the trust has compounded 9% return since launch. We've put the performance there against the MSCI Equity Financials and against the Lipper Financial Peer Group. So we've outperformed on that basis. We've also put the UK banks up there just to highlight that whilst UK banks have seen some improved performance more recently, over the longer term, they've quite significantly underperformed. And to us, that really just highlights the importance of taking a global and diversified approach when investing in the sector. So as a brief summary on the investment case, so the sector has outperformed the last couple of years, but valuations remain very attractive. So both on an absolute basis, it's trading at low multiples, also relative to the market, often trading at actually record lows, also pre-COVID lows in terms of broader market relative valuations. The sector is a clear beneficiary of rising rates, and we're seeing that tailwind to earnings coming through at the moment. Capital return is a key theme. So we're seeing capital being returned through both dividends and buybacks, and we expect that to be sustained going forward. There are many structural growth aspects to the sector as well, which we'll explore a bit more later on, but that includes financial inclusion through emerging markets, the rise of fintech, market share gains with small and specialist financials. And as a broader sort of more medium-term point, we are seeing a reassessment of what is a more normalized level of inflation and interest rates. And this sector is very much placed for that rotation from growth to value that we've been seeing going on the last couple of years. So understandably, there's a lot of focus on asset quality at the moment, given a slowing economic environment. Main message being that whilst we do expect some increase in provisioning, we are not seeing a material change in terms of asset quality trends. So on the left-hand side, we show loans in default or non-performing loans. You can see a major spike during the financial crisis. It's continued to trend down, some increase during COVID, but broadly since then, it's been stable at pretty low levels. The feedback that we've been getting from management is that whilst there are pockets of deterioration, so within, for instance, subprime or some aspects of consumer within the 60 to 90 days overdue, broadly, they're seeing a stable picture. On the right-hand side, we're looking at provisioning for the US banks. So these are the reserves that they hold against loans in default. These have risen since 2019, and they remain well in excess of non-performing loans. There is a buffer there in terms of earnings. Another reason why we're confident in terms of sort of ability to withstand a slowing economic environment is that the banking sector hasn't added much risk going into this slowdown. So often the key determinant of future asset quality is the pace and type of lending you're doing going into that slowdown. So in contrast to the financial crisis, a time in which you had very high levels of loan growth, you had a loosening in credit criteria. This time we've seen a much lower risk appetite, much more prudent lending, and a lower level of lending. Now, as this graph shows, this looks at high-risk corporate debt or sub-investment grade. You can see that's been stable at the banking sector over a long period of time, but it's risen within the non-bank space. So we're not saying that there isn't risk in the system, it's just primarily been taken more outside of the banking sector. So recent performance has been supported by earnings upgrades. So you can see for the banking sector, they've been particularly strong, but also for insurance and diversified financials. The banking sector, particularly sensitive to rising rates, and that supported upgrades. As you can see on the right, those upgrades, which is the dark blue line, have come through, and in some cases, as it is for the banking sector, they've exceeded the share price rises. So whilst we've seen a recovery in share prices, actually a number of the stocks have derated. So valuation support remains very much in place. I think it's important to look at other periods of high inflation and rising rates to see the impact on the sector. So if you look back at US banks during the 70s, on the left-hand side, you can see the continued rise in terms of their profits. So as margins widened, that offset the rise in provisioning. Nominal loan growth is also relatively high. But also importantly, on the right, you can see that they took market share during that time. And that's a dynamic that we're seeing happening at the moment as well. So after many years of a deposit base being a drag on profitability, it is now a competitive advantage. So they can price more keenly than some of the non-bank lenders. And we're starting to see that coming through now. So in terms of the macro outlook, certainly has been a challenging environment to call the outlook. There's still a lot of debate as to whether we're going into a hard landing or soft landing. At the margin, some of the data has been better. But I think, certainly still an uncertain outlook. And what gives us comfort is the level of savings on households' balance sheets. So on the right-hand side, you can see for each income cohort in the US, savings levels remain well in excess of where they were pre-COVID. If you take that graph through to today's date, that still remains the case for all but the lowest income quartile. And we think that's why, despite rising interest rates, the asset quality has remained relatively benign. On the left-hand side, you can see the debt service ratio, so the proportion of your income that you're putting forward to debt payments. You can see that it is rising, but still not elevated in a historic context. Also important to note, each market has its own dynamics. So in the US, the 15-year and the 30-year mortgage fixed products are popular. So the average duration on mortgage loans is 23 years. So not many households are rolling over onto higher rates. You contrast that with the UK, where you have a 2-year or 5-year fixed products, you have about 40% of borrowers are rolling over this year. So each market has its own dynamics. So turning to balance sheets, what have we seen? We've seen a strong increase in terms of capital levels for both European and US banks. Over the last 10 years, there's been a strong increase in terms of regulation. Banks have continued to build up capital levels, and they're now in surplus positions. Importantly, we also have a much clearer outlook in terms of regulatory requirements, and that gives managements confidence in terms of the amount of capital they can return to shareholders. So if we look at capital return, you can see for US banks on the left, that's exceeding 6%. So when you include both buybacks and dividends, for this year, expected to be over 6%. For European banks, on the right-hand side, we've looked at the last dividend for 2022 and the projections for this year. So a number of our holdings are yielding in excess of 10%. Now, given surplus capital positions, we expect high yields to be maintained, not just this year, but also in subsequent years as well. So turning to other parts of the trust, emerging markets, 21% of the trust. This has been an area that we've been adding to recently. Countries such as India, which is a key overweight for the trust, positive on the long-term outlook. You have very high-quality private sector banks in India. They're taking market share from the capital-constrained state banking sector. Penetration levels are low. We think about mortgage to GDP in India is about 11%. You compare that to about 50 or 60% in the US and the UK. So we see a very long runway in terms of growth for Indian banks. They can generate strong levels of profitability, ROEs in excess of 20%. We're also looking to play the reopening of China as a theme. So whilst we don't invest directly within state banks in China, or we struggle in terms of transparency, we're able to play that theme through, for example, life insurance sales through Hong Kong and China, or it could be through something like the Hong Kong Stock Exchange. Insurance, the second largest subsector at 20% of the trust. This has been a very defensive subsector last year. benefiting from a hardening rate environment. So you can see on the left-hand side, insurance rates have continued to rise. And whilst those rate rises have moderated, they still remain in excess of claims inflation. So it's been a supportive backdrop. Valuations have risen. So on a relative basis, valuations looking a bit less attractive. We've taken a little bit off some of our non-life holdings, but still seeing good opportunities within this space. Now, fintech, this is certainly a sort of broadening part of what we look at. An increasing in terms of the universe of stocks that we can invest in. I think what has prohibited us from investing has been the very high valuations in that space. Now, last year we had a major sell-off in technology, also within the fintech area. That's increased the amount of sort of potential investments for us. We have a preference for more sort of mature fintech businesses. Those that are more fee income generating. So we like payments type businesses. So we have holdings in areas such as Visa, MasterCard. In Europe, we have an investment in Adyen. We also like some of the online wealth management players. So companies like Fineco Bank in Italy, Moneybox is an unlisted investment within the UK. A lot of interesting opportunities within the fintech space, particularly after the sell-off. So valuations for the sector, we see strong valuation support. So on an absolute basis, global banks trading at 8.8 times earnings. This table looks at the number of days traded at a particular multiple or cheaper since the financial crisis. So all it's saying is banks at 8.8 times earnings have only been this cheap 23% of the time. You contrast that with the insurance space where they're trading more towards the upper end of that range. So from both an absolute basis and relative, we see strong valuation support. So this chart looks at the rotation that we've seen from growth to value, so the proportion of the MSCI World Index. Since we've had that change in inflation regime, a rise in interest rates, we've seen a shift from growth to value. And we think there will be an ongoing reassessment of this, and that supports a continued sort of mean reversion in this chart. And often a change in market leadership takes multiple years to play through. So we certainly think there is further to go within this shift. So as a quick overview of the trust, as noted, banks, the largest subsector at just under 60%. That's been an area that we've been adding to a bit recently. So we've added some of the European bank holdings, seeing strong tailwinds to earnings from rising rates, attractive valuations, adding to certain fixed income as well. Again, risk reward very attractive. A lot of securities yielding around sort of high single digit levels. And that's been funded by taking up the gearing ratio from around 3%, currently sort of 8 to 9%. We've taken a bit off our non-life holdings as well. From a geographic perspective, US remains the largest exposure, albeit we've been adding a bit to Asia Pacific and Europe. And just to note, on the UK, we have a soft limit of around 10%. So to give that global diversified exposure, should investors already have one or two UK financial holdings. So in summary, we see the sector at a very interesting juncture. You have a lower risk sector now. It's spent a long time building up its balance sheets, strengthening capital. It's now returning capital to investors through high yields. It's seeing a good earnings tailwind from rising interest rates, and valuations remain attractive. So with that, thank you for your attention. I'll leave it there.
George, thank you very much. Okay, I've got quite a lot of questions. So in no particular order, you mentioned at the start the weakness in UK banks have underperformed. Do you see that carrying on?
Well, I think we've now had the UK bank results the last week or so. They've shown some very strong increases in terms of profitability. They sold off following the results, given some concerns that they've reached peak NIMs. So I think on a relative basis, we're seeing more opportunity elsewhere. I think, as I mentioned, you have a large proportion of borrowers rolling over onto higher interest rates. So from an asset quality perspective, we had a little bit more concern about the impact to the UK than we have with other markets. From a margin perspective, again, I think it's very important to look at the type of deposit structures. So UK, we might see some slightly higher migration towards time deposits. You compare that to a market like Ireland, much more consolidated. You have really essentially two banks there, So the deposit mix is much more favorable, and we think there'll be more tailwinds to margins going forward. So, they're not expensive. They are seeing good increase in profitability, but on a relative basis, we're seeing more opportunity elsewhere. And that's why within the UK, we don't own the domestic banks, but we have exposure to the UK Asians. So both HSBC and Standard Chartered are in the portfolio, but we're seeing good tailwinds to margins, but also that support from China reopening.
Thank you. And next question says, a comment today on Bloomberg, there is falling or no demand for commercial loans. Do you agree? And if so, how does that impact the trust?
I'm not sure what geography that refers to, but I mean, as we go into a slowing economic environment, certainly that will impact loan demand and loan growth. I would say that we are able to find good loan growth, and it depends on which geography that we're looking at. So it is a global trust. You think about, we're investing in emerging markets. In India, they're growing their loan book 20%. Similarly, mid-teens in Indonesia. So there is a lot of opportunity for growth. In developed markets, I would agree that we are going to see low levels of loan growth, but because profitability is rising nicely, we're seeing high levels of capital being returned to shareholders. So banks don't need to retain that capital, and that is being returned.
Next question. Is there much M&A activity in financials?
Yes, we are seeing a bit happen. I mean, for instance, we had First Abu Dhabi Bank's speculated bid for Standard Chartered a couple of weeks ago. We've had some sales in the US towards European businesses, some sections of European banks' businesses. So it is ongoing. I would say it's probably less of a theme than it was before because of regulatory restrictions. So cross-border M&A still remains quite difficult. By cross-border, there's often capital implications which make it quite difficult. And I think that's probably the reason why we haven't had a conclusion towards the Standard Chartered bid. So it is ongoing, but I wouldn't say it's a sort of core theme.
Next question is a contentious one, slightly perhaps. Are you assessing crypto? And I guess with that, the crypto ecosystem, so exchanges or other listed vehicles which give you crypto exposure.
Yeah, we don't have exposure to crypto. I mean, I think indirectly, we have seen investment banks looking at distributed ledgers, types of using that sort of technology. There are certain banks that were exposed to crypto, so I could name a bank like Signature Bank in the US. But it's a very volatile asset class. I think we've seen that if you're basing your business model off it, you can see deposit flows coming in and out very quickly. So I think for us, it's not an area that we want exposure to.
Next question is about unlisted or private companies. You mentioned Moneybox. Do you have any other private companies? Do you have any mandate to increase or would you look to try and increase or decrease your private holding?
Yeah, so we have two unlisted at the moment, Moneybox, which I mentioned at the start, and Atom Bank as well, which is the first UK bank to get a digital license, just moving towards break even at the moment. I think we are looking to use the trust structure to find those kind of unlisted opportunities. So if we do find an exceptional business, we will look to take advantage of that. So it could be a growing part of the trust going forward.
Do you have any limits as to how much you can hold or any parameters?
There's a soft limit of around 10%. I mean, we're well under that at the moment. It's around sort of 1% of the trust.
Next question is about consumer credit card debt in the US, saying it's at record levels as consumers struggle with high inflation. Do you see a risk of debt defaults from credit card borrowing and then a knock-on negative impact on the sector?
Yeah, it's a good question. I think that is an area that is probably most exposed to seeing some deterioration. We're seeing that in terms of the subprime space, but it really depends on the income quartile that you're exposed to. So the banks in the US are not generally that exposed to sort of subprime or lower quartile credit card lending. Some of the consumer lenders are. So I think we will see some deterioration there, but probably more focused within the lower income quartile.
Next question is about gearing. Do you use gearing? If so, what's the current? What is the current position?
Gearing currently 9%. It has we have the ability to take it up to around 20%. I think the maximum has been around 15–16%. So we will look to use gearing when we see opportunities to do that.
Would you be increasing or decreasing or staying stable at the moment, George? What's your outlook?
Yeah, so the trend has been increasing. So if you think about last year, we had Russia's invasion of Ukraine, a real risk-off period. We looked to become more defensive and we took gearing down. Then from around the sort of third quarter, when we saw valuations come off a lot, we thought the market was pricing in too much negativity. From that point, we started to add some risk. We started to take up gearing from a slight cash position. We finished the year at around 3–4% gearing. We've subsequently taken up to around 9%. So the trend has been to add gearing.
Question from me now. James mentioned in his presentation about selling a direct line or lowering his position in direct line. I'm always interested to hear about sell disciplines. Many investors struggle with when to sell, how do you decide when to sell, George? And how do you what were the red flags for you, or what prompts you to start decreasing position?
Yeah, we look to be disciplined in terms of our sort of in price and exit price. So we have a quantitative approach which looks at various valuation metrics that helps us with target prices and exit prices. So there's a quantitative approach there we look to be disciplined on. But also if we see some red flags like a material change in strategy, an inconsistency in terms of what management is looking to deliver, then we would look to reassess in terms of the investment case. So it's both quantitative and sort of qualitative factors.
So what's the portfolio turnover like?
I mean, it varies. I mean, during sort of COVID period, we turned it over significantly, but it would average around sort of 30% in a typical year.
Okay. George, I think we're done there. Thank you very much indeed for presenting. Thank you for joining us tonight.
Thank you.